Regarding the rare earth industry in the United States, we continue to talk about it from the last issue. The United States is not new to the vulnerability of the rare earth supply chain. This problem has troubled its strategic planners for more than a decade. However, why has there not yet been a mature and crisis-proof solution? The answer is complex and profound, rooted in multiple aspects such as economy, technology, environment and policy. To understand today's predicament, we must look back to history. Ironically, the United States was once the pioneer and leader of the global rare earth industry. The Mountain Pass mine in California was once the world's largest source of rare earths. From the 1960s to the 1980s, it almost met the needs of the world and provided key materials for the development of early color TVs and technology. In the late 1980s, China began to mine rare earths on a large scale and impacted the global market at extremely low prices with its huge reserves, low labor costs and relatively loose environmental standards. As the operator of Mountain Pass, Molycorp is struggling under the dual pressure of market competition and increasingly stringent U.S. environmental regulations. In 2002, Molycorp was forced to stop processing at Mountain Pass due to a leak in a wastewater pipeline that was handling radioactive thorium. Although the mine attempted to restart around 2010, China's rare earth embargo in 2010 due to a territorial dispute with Japan caused global rare earth prices to soar, which should have been a great opportunity for Molycorp. However, the company faced huge technical challenges and financial pressures during the restart process. Ultimately, when China relaxed regulations and rare earth prices plummeted, Molycorp, which was burdened with huge debts and failed to effectively build downstream processing capabilities, declared bankruptcy in 2015. The Mountain Pass mine was once acquired by a consortium involving Chinese company Xinghe Resources, which was regarded as a major failure of the U.S. rare earth strategy. Molycorp's failure is a textbook case that reveals the core difficulty of rebuilding the U.S. rare earth supply chain. In a purely commercial market, private companies cannot compete with opponents with national strategic support and cost advantages. Since the rare earth shock in 2010, although the U.S. political and military circles have repeatedly emphasized its seriousness verbally, the actual actions have been extremely slow. The reasons are as follows. The first point is the absolute disadvantage of economic cost, which is the most fundamental obstacle. Thanks to state subsidies, integrated industrial clusters, low environmental protection and labor costs, China's rare earth industry can supply products at low prices that Western private enterprises cannot match. Without strong government intervention, any high-cost project carried out in the United States is commercially unfeasible. Capital is profit-seeking and it will not flow to an industry that is doomed to lose money. The second reason is technical barriers. Separation and smelting are the real neck links. Mining itself is relatively easy, and the real technical difficulty lies in downstream processing and separation. Rare earth ores contain 17 elements with extremely similar chemical properties. It is extremely complex to extract and separate them one by one, and it requires a lot of proprietary technology. In the past few decades, China has accumulated the world's most mature and lowest-cost separation and smelting technology through practice, and has formed patents and technical barriers. The United States has suffered a serious loss of technical talent and infrastructure in this area. The third reason is the strict constraints of environmental regulations. The mining and processing of rare earths will produce toxic chemicals and radioactive byproducts, such as thorium and uranium. In the United States, any such project must go through an extremely long, complex and costly environmental impact assessment and licensing process, with significant NIMBY effect. This means that a project may take 10 years or even longer from planning to production, while China's approval process is much faster. The fourth reason is the huge risk of capital investment and the long cycle of investment returns. Establishing a complete vertical supply chain from mines to magnets requires billions or even tens of billions of dollars in investment, and the investment return cycle is extremely long. The sharp volatility of rare earth prices makes investment risks extremely high. Without long-term and stable procurement commitments, especially government and military orders, private capital and financial institutions dare not easily get involved. The fifth point is the policy swing and lack of a long-term national strategy. For a long time, the U.S. response has remained at reports, hearings, and sporadic R&D funding, lacking a long-term national strategy driven by the highest level, across departments, and providing continuous financial support. It was not until recent years, with the comprehensive intensification of Sino-US strategic competition, that the situation began to change fundamentally. Despite the above difficulties, in recent years, the U.S. government has finally elevated the rare earth supply chain issue to the highest level of national security and has taken a series of unprecedented measures to try to systematically solve this problem. The first measure is the direct investment authorized by the Defense Production Act and the Department of Defense. Using the authorization of the Defense Production Act, the U.S. Department of Defense has directly invested hundreds of millions of dollars in a number of key projects aiming to open up all links from mining to processing. The main projects include MP Materials, funding it to build a heavy rare earth separation and processing facility in Mountain Pass. Previously, MP could only produce light rare earth concentrates, and heavy rare earth processing capacity was a key shortcoming. Lynas Rare Earths, funding the Australian company to build a heavy rare earth separation plant and a light rare earth processing plant in Texas. This is a typical manifestation of the friendly shore outsourcing strategy. Eucor Rare Metals, funding it to build a strategic metal complex, SMC, in Alaska using its proprietary Rapid SX technology for rare earth separation. Novian Magnetics, invested in this Texas-based startup to expand its ability to produce high-performance magnets using recycled materials. The second measure is the legislative incentives of the Inflation Reduction Act, IRA, and the Bipartisan Infrastructure Act. These bills provide powerful fiscal tools. For example, the Advanced Manufacturing Production Tax Credit in the IRA provides a 10% tax credit for the production cost of key minerals, including rare earths, produced in the United States. This fundamentally changes the economic feasibility of domestic projects and injects a shot in the arm for private investment. The third measure is to establish strategic reserves and deepen international cooperation. The U.S. Defense Logistics Agency, DLA, is actively purchasing rare earth products to increase the National Defense Reserve. At the same time, the United States is actively working with allies such as Canada and Australia to jointly build a Critical Mineral Security Partnership, MSP, that excludes China to coordinate resources, technology and funds. The fourth measure is to promote research and development, recycling and alternative technologies. The U.S. Department of Energy, DOE, and other agencies are funding research on rare earth recycling technology, from waste electronics and magnets, and the development of new magnet materials that contain no or little rare earths, in order to reduce dependence from the demand side. In summary, the United States has entered the actual investment stage of real money from the verbal warning stage. A multi-level response framework consisting of government-led, legislative incentives, military procurement and international cooperation is taking shape. However, it will take several years or even decades to rebuild a complete and competitive industrial chain, during which time the vulnerability of its supply chain will continue to exist. In this industry with bright prospects but a long time to establish and improve, can we find some potential investment opportunities? Let's make some simple understandings. Investing in U.S. rare earth and related supply chain companies is essentially an investment in a geopolitical game. Its core logic is, betting that the United States and its allies can successfully establish an independent and economically viable supply chain of key minerals driven by national security. We must be clear, this is a high-risk, high-potential return field. Next, we will understand and analyze the relevant companies, covering multiple links from upstream mining to downstream processing and application. The following companies are the pillars of rare earth production in the current Western world and are also the core targets of support from the U.S. government. The first company is MP Materials Corporation, stock code MP. It is the only and largest rare earth producer in the United States, operating the historic Mountain Pass mine. At present, it is the flag bearer and the biggest beneficiary of the American rare earth renaissance. With a monopoly position in the upstream, it owns the largest and highest-grade rare earth mine in the Western Hemisphere and has achieved stable operations and cash flow. The vertical integration strategy is divided into 3 steps. The first step is to mine and produce rare earth concentrates, which has been achieved. The second step is to separate locally and produce separated rare earth oxides, such as NdPr oxides, to get rid of dependence on China's processing. This step is in progress. The third step is to extend further downstream to produce rare earth metals, alloys, and ultimately permanent magnets. This work is still in the planning stage. Thanks to the strong support of the government, the company has received several large grants from the Department of Defense to build heavy rare earth processing facilities and support its downstream plans. It is a direct beneficiary of the IRA Act tax credit. Its core product NdPr is the key to electric vehicle and wind turbine magnets, and the long-term growth trend of market demand is clear. General Motors, GM, has signed an offtake agreement with it. However, we should also pay attention to the risk side factors. Its dependence on China still exists. Before the second step is fully put into production, its rare earth concentrate still needs to rely on Chinese partners, Xinhe Resources, for underwriting and processing, which is both a cooperation and a potential risk. Then, there are also technical execution risks. Rare earth separation and smelting technology is complex, and project construction and capacity ramp-up may face delays and cost overruns. Especially heavy rare earth separation technology, the challenge is huge. In addition, this company has a single asset risk, that is, all the company's operations are concentrated in one mine in Mountain Pass. And rare earth prices are greatly affected by the global macroeconomics and Chinese policies. The second company is Lynas Rare Earths Limited, Australian stock code, LYC, US OTC code, LYSDY. This company is the world's largest rare earth producer outside of China and is currently the only non-Chinese company that can provide separated rare earth products on a large scale. The company has successfully operated the Mount Weld high-grade mine in Australia and the Advanced Materials Plant, LAMP, in Malaysia, with more than 10 years of separation and processing experience and proven technical and operational capabilities. Assets are distributed in Australia, Malaysia, and the United States, effectively diversifying the policy and operational risks of a single country. As the only non-Chinese company that can immediately provide separated rare earths, it has obtained multiple large contracts from the U.S. Department of Defense to build 2 processing plants in Texas, deeply embedded in the U.S. defense supply chain. The company's customers are spread across Japan, Europe, and the United States, and customer relationships are stable. In addition to the above advantages, there are also the following risks. Its Malaysian plant has faced challenges from local environmental regulations and political censorship. Although it has been resolved, it is still a potential risk point. The company is simultaneously promoting multiple large-scale expansion and new construction projects in the United States and Australia, which poses a test to capital expenditure and project management capabilities. Of course, like MP Materials Corp., it also faces the risk of rare earth price fluctuations. The 2 companies introduced above are already large companies in the global rare earth field, but they are still not comparable to China's leading rare earth companies. There is still a clear gap between them and Chinese companies in the full process capabilities from rare earth mining to the production of rare earth metals. Next, we will share some other related companies, and the future dark horses in the rare earth field may emerge from them. These companies have rare earth resource projects, but have not yet entered large-scale production. Their value depends on whether the projects can be successfully developed and financed. The first company is Eucor Rare Metals Incorporated, Canada Venture Board Code, UCU, US OTC Code, URAF. This company focuses on establishing an independent rare earth supply chain in North America. Its core assets are the Bokendotzen Ridge Rare Earth Project in Alaska and its proprietary RapidSX separation technology platform. RapidSX technology aims to provide a more efficient, lower cost and more environmentally friendly method for rare earth separation, which will be a huge subversion if commercially verified. The Alaska project is located in the United States and is in line with the national security strategy. The company has received preliminary funding from the Department of Defense for its engineering research at the Strategic Metals Complex, SMC, in Louisiana. Since RapidSX technology has not yet been tested in large-scale commercial operations, there is a very high risk of technical verification. The project also requires huge financing, and whether it can successfully raise funds is also the key. In addition, the final mining economics of the Broken Mountain project still need to be further verified. The second company is Neocorp Developments Limited, NASDAQ, NB, TSX, NB, which plans to develop the Elk Creek Critical Minerals Project in Nebraska. The Elk Creek project is not only rich in rare earths, but also the largest or only niobium, scandium and titanium deposits in North America. This diversification can mitigate the price volatility risk of a single mineral. This is also a domestic project in the United States, so it is fully in line with the strategic direction of localizing critical minerals. The project has completed a feasibility study and is seeking financing. On the risk side, financing is the biggest obstacle. The project is expected to require more than $1 billion in initial capital, which is extremely difficult to finance. In addition, the complex metallurgical process of extracting multiple metals from one or at the same time is technically challenging. The third company is Energy Fuels Incorporated, U.S. Exchange Code, UUUU, which is the leading uranium producer in the United States, but has strategically entered the rare earth field in recent years. The company is using its fully licensed White Mesa uranium processing plant in Utah to process monazite sand to produce rare earth carbonates. This greatly reduces the initial capital investment and licensing time to enter the rare earth processing field. The company has signed supply agreements with monazite sand producers in the United States, Brazil and other places. It does not rely on a single mine, allowing the project to have a diversified source of raw materials. The company's business model is clear, and it is gradually expanding from the production of mixed rare earth carbonates to the upstream separation business. But it also has the following risk factors. The first is the dependence on third-party raw materials. The company's business model depends on the ability to continue to obtain a stable supply of monazite sand. Then, the company's performance is still affected by uranium market prices and policies. In addition, some technical capabilities have yet to be verified, and there are still technical barriers to overcome from producing mixtures to complete separation. The fourth company is USA Rare Earth, LLC, a private company. One of its trump assets is the Round Top Rare Earth and Critical Minerals Project in Texas. The project has huge resource reserves. Round Top is one of the world's largest heavy rare earth and lithium deposits. How big are the reserves? Simply put, one mine may meet the needs of the United States for hundreds of years in the future. The company has laid out downstream magnet production and has acquired a rare earth magnet manufacturer in Pennsylvania, the assets of the former Hitachi Metals America, aiming to create a complete domestic supply chain from mines to magnets in the United States. This company has obvious advantages and a clear strategic direction, but there are also some risks. The company is currently private, but there are strong expectations for listing, IPO. Investors need to pay close attention to its listing progress. Although Round Top has huge reserves, the ore grade is low and it needs to rely on innovative, low-cost mining and processing technologies, such as continuous ion exchange, and its commercial feasibility needs to be verified on a large scale. The above is the information and brief analysis of the relevant companies. If you want to invest in the above companies, you must be aware of the following common risks. 1. Price volatility risk. China remains the world's largest rare earth market player, and its production and export policies can significantly affect global prices, thereby affecting the profitability of these companies. 2. Technical execution risk. Separation and smelting technology is the core bottleneck. Any project delay, cost overrun, or failure to achieve expected production and purity will seriously affect the company's value. 3. Financing and dilution risk. Most companies in the development stage need to continue to raise equity or debt financing, which may lead to dilution of the interests of existing shareholders. 4. Environmental and licensing risks. In the United States or Canada, obtaining all the licenses required for mining and processing is a long and uncertain process. 5. Geopolitical risks. Although the current Sino-US competition is the biggest catalyst for the development of the industry, if the relationship between the two countries unexpectedly eases significantly in the future, it may weaken the urgency and determination of the U.S. government to support the domestic supply chain, thereby affecting the industry valuation. Finally, let me give a simple summary. The U.S. government has sounded the assembly call to rebuild the rare earth supply chain and invested substantial resources. This provides related companies with unprecedented historical opportunities. For investors who can withstand high risks, this is a strategic track that can be deeply involved and may reap rich returns. For conservative investors, you can focus on MP Materials and Linus, which are the industry leaders with the highest certainty at present. For risk-averse investors, you can study companies such as Energy Fuels that enter the track through innovative models, as well as developers such as Ucor and Neocorp that have unique technologies or resources but higher risks. In addition, all interested investors should pay close attention to the potential IPO of USA Rare Earth, which may become a game-changing event in this field. Okay, the above content is just personal opinion, not investment advice. Please think critically. Thank you for your company.